After a massive sell-off and more headlines surrounding the U.S.-China trade war, what should investors do now? Michael Reynolds, investment strategy officer at Glendmede, joins me. Despite fears that Trump's tariffs are going to heavily impact the consumer, Walmart released an earnings beat and raised its guidance for 2019. Can the strong consumer withstand the trade war?
So I think we saw in the Q2 GDP report, that the consumer is driving forward this economic expansion at this point, helping to withstand some of the weakness we've seen in the manufacturing economy. And we see the retail sales report this week, or today actually, that we're beating expectations on that front. And if we look at the structure of tariffs so far, instead of everything going into place on September 1st, the Trump administration has now announced that some of these bigger ticket items are actually going to face tariffs later this year. This matters because some of the biggest consumer events actually happen toward the end of this year. We're talking Black Friday, Christmas sales, and those companies that are importing those goods are sort of getting their inventory on before the tariffs come into effect. And this can help keep costs lower through that big, again, one of the bigger events for the year here. So I think the consumer is relatively healthy at this point, driving forward this record economic expansion, and we expect to continue to see them to do so.
Now, you mentioned the bigger ticket items, like a lot of the tech items are taken off the plate, and the tariffs are expected to go on December 15th. But we still have a lot of retail items that are expected to have a September 1st tariff. I'm wondering, do you think that September 1st tariff will stay in place?
Sure. So, everything can change on a tweet. That's the nature of where we are right now. Until we hear further notice, I think we have to assume that those tariffs are going to go into place and have that incremental effect on making perhaps a subset of consumer goods a bit more expensive. But again, I think I want to return to the fact that the consumer is so healthy, so much driving forward this expansion at this point in time, that we think they can withstand this sort of impact of higher consumer goods at that point, whether it's apparel, toys, footwear, et cetera. The strength we've been seeing in that side of the economy should be enough to withstand some of this weakness.
So do you think that this will have any impact on GDP growth?
Yeah, so we're looking at sort of tariff impacts overall on GDP growth. And when these go into effect, we're looking at about a 0.3 to 0.4% hit to GDP growth at this point. It's important to think about growth and sort of the impact that tariffs can have on them on a rolling 12-month window, where if we think about tariffs, they sort of have a permanent effect on potential GDP. So if you're looking at the level of GDP, that sort of takes a hit once tariffs go into effect and sort of follows parallel to where GDP is going as things go forward, assuming they stay in place on a sustained basis. But if you're looking at the growth in GDP, sure, as you sort of hit that little impact in the beginning, you'll see that impact on growth. But as you go beyond that 12-month window, you actually start to see it fall off of that growth. So some of the tariffs we saw last year, the 50 billion, 25%, the 200 billion, the first tranche, the 10% on 200 billion, those impacts are actually starting to wear off at this point, just as the new tariff impacts are starting to come in. So, we're not seeing this as something that's going to blow off growth at this point. We still have a sort of healthy growth expectation, well above zero for the U.S. at this point. But it is just another incremental headwind that we're going to have to withstand at this point.
We saw a lot of volatility this week. Tuesday, we saw the markets up. Then Wednesday, we saw the markets close down 800 points on the Dow. With the markets turning like this on a dime, what is the most important thing that the average investor needs to keep in mind?
So I think the average investor needs to sort of avoid the headline risk and sort of keep true to their longer term goals at this point, their longer term asset allocation targets, whether it's between stocks and bonds. Try to avoid trading and timing the market. If you miss out on the 5 to 10 best trading days in a given year because you're trying to time the market, it can have a very material impact on your overall portfolio returns. It's very hard to time the market and decide where it's going to go in any given day. There will be opportunities to take advantage of valuation disparities. This might not be the opportunity yet. So we're sort of recommending that investors sort of stay the course at this point, but sort of keep vigilant as we're seeing a lot of these risks sort of pop up on the margin.
Why should bonds keep the average investor up at night?
Sure. So I think equity markets have sort of been conditioned to be watching the bond market, particularly the yield curve, for signs that recession is coming. We've seen the 2-10 curve or the 3-month 10-year curve. Some people like to quote one or the other, but both are inverted or have inverted over the past couple days, and we even saw the 3-10 invert earlier this year. tend to see that portend future recessions, but at this point, we're sort of discounting the signal that the yield curve is giving us at this point. We're seeing some pretty big global dislocations in the bond markets, whether it's the German yield curve. The entirety of the German yield curve is in negative territory now. $16 trillion worth of global bonds are trading at negative yields. I mean, these are mind-boggling sort of stats, and there's a subset of the market out there that has to sort of buy bonds on a sort of systematic basis, whether they're matching assets, liabilities, pension funds, insurance funds. They need to match their liabilities. So we're seeing a lot of buying pressure on global bonds. And if you're comparing the US yield to a German bond or even some of the periphery bonds like in Portugal, Ireland, Italy, the US is the only place you can really get yield right now if you want safe, less risky bonds. So that demand factor is sort of keeping US bond yields on the long end lower. We're seeing a bit of inversion there, and we think it's largely because of this sort of technical factor, this global demand story that's giving off this signal. So we're sort of wondering at this point if the global bond market, or the US bond market in particular, is sort of giving a false positive on a recession signal at this point.
That's really interesting. That's a different take than I've heard. So you think that there won't be a recession on the horizon just yet? You think that this might just be a false positive? Or
So we think it's a bit premature to be calling for a recession in the next 12 months at this point. Certainly, global risks have risen. We've seen geopolitical tensions rising, whether it's Hong Kong or in Italy, a turnover in government perhaps. We're seeing in a slowing manufacturing economy that's bleeding a little bit over into the US, but not enough to sort of knock us off of our global or our domestic growth trajectory at this point. We have an internal model where we sort of try to estimate the probability of recession within the next 12 months. We're currently seeing about a 20% chance of recession from that model at this point. It has risen over the last few weeks in sort of recognition of these rising risks we're seeing on the horizon, but it's just not the base case yet. But I think at this point, investors sort of need to recognize that the probability is rising, perk their ears up, and be watching for signals that this could take a turn for the worse.
20% is still pretty low. All right, so the 10-year inverted briefly Wednesday morning. Looking at that and basing this off of what you just said about global bonds, how should the average Joe understand what happened with the inverted yield curve and what it means?
Sure. So, I think of the yield curve, we try to compare the yield on shorter term bonds and longer term bonds. When you see shorter term bonds yield more than longer term bonds, that has historically been a signal that a recession is coming. Now, this time around, we're sort of recognizing that there's perhaps some dislocations in the market on a global scale that have been messing with the signal that we've been getting there, that it's probably not giving the traditional signal of recession that it has in the past. I think part of that is global demand with negative yields across the globe at this point, with a German yield curve all the way out to 30 years, you're getting negative rates. You're basically paying for the privilege to lend the German government money at this point. Investors need yield, and when they're looking for yield, the US is the only game in town. We have positive yields, and we're a relatively risk-free sort of investment on the Treasury perspective. That demand is bringing down the long end of the curve. On the short end, the Federal Reserve has been cutting rates. They did it for the first time last month, and there are expectations that they're going to continue to do so in the future. And that short end of the curve is sort of influenced by Fed policy. So as we expect Fed funds to sort of come down the rest of the year, the Fed funds futures market is pricing in a base case for 2 more rate cuts by the end of the year. So if we continue to see that short end come down, we might actually get to a bit more of an equilibrium in the long term and the short term. So, I think there's a lot of technical factors at this point that are driving this yield curve inversion. So I would be a little cautious in reacting to it too quickly.
Thank you so much.
Yeah, pleasure.